Welcome to TheoTrade. This is Don Kaufman, March 19th, 2022, doing the TheoTrade weekend update on a Saturday morning. Oil, inflation, geopolitical risk. Have markets bottomed? All right, first and foremost, let us state the obvious. The absolute quintessential rip your face off rally transpires throughout the course of this week of trade. I mean, it was a ripping, blistering move to the upside. But again, that is the obvious. A few of the things that we're going to do in this weekend's update, first we'll talk about fun with the FOMC, because I believe aspects of what have transpired in the yield curve need to be discussed before anything. But thereafter, we're going to look at some very specific trade setups in this particular environment. So let's get started with, again, what I term fun with the FOMC. And I call it that because, again, I think that there's aspects of what have gone on with the FOMC in this last week. Of course, we just went through a Fed meeting, right? Fed, we have liftoff, a 25 basis point increase, and of course more to come. There's not that much to mention that hasn't been stated about the Fed. Some people are like, they were very hawkish. I don't necessarily believe so. I mean, they could have talked about the balance sheet and the runoff of the balance sheet. Don't worry, there's only about $9 trillion on the balance sheet right now, but neither here nor there. Okay, one of the points that hasn't been looked at a tremendous amount by market participants, okay, is where interest rates presently are and what they are saying. And for that, I'll tell you what, we're going to jump right to it, because I think that this right here, right now, and you're like, well, what's this? This is actually the U.S. Treasury website. Oh, it's such an exciting website, right? But let me get to some specifics inside of here of why we're looking at the U.S. Treasury website. For those of you that actually understand a little bit about this, what you're looking at here, okay, are the yields. And I'm actually highlighting them a little bit. And again, we're going to get to some very, very specific yields here, where you look at like the 2-year, the 3-year, the 5-year, the 7-year, the 10-year, the 20-year, the 30-year. And I'm just highlighting these, okay? And then you can look at, well, specific dates. This is pretty much halfway through the month of March. It's end of day. And again, this is the interest rate, if you will, associated with the 2-year, the interest rate associated with the 3-year. So let's unhighlight things for just a second and look at, okay, just the most recent trade date. And again, let's get right down to business, and I'm going to highlight this little monkey right here. So we're looking back at, of course, March 18th. So why? Why are we over here on the Treasury website? I just want you to take a look at the 3-year. Okay, look at the 3-year, and then let's get crazy, and let's actually compare it, for instance, to the 10-year. Now, okay, if this is not clear to you, what's actually transpiring, this is a very flat yield curve. In fact, the yield curve is actually inverting already. So some people look at like the 2-year versus the 10-year. Some people talk about the 5-year versus the 10-year. I mean, first of all, the 5-year versus the 10, it's totally flat, 2.14, 2.14. You took a look at the 7-year, okay, is 2.17 versus 2.14. What is actually going on over here is you're starting to see, again, a flattening of the yield curve, okay, and even a little bit of inversion of the yield curve. Why do I mention that? Because it's one of the, the cardinal sins of the marketplace. It's actually a sign of recession when the yield curve starts to invert. Now, I'm not going to sit here and argue the point. Is it the 2-year versus the 10-year? Leave that to the macro economists out there. Nevertheless, there's no question. It's unequivocal that the yield curve is seeing some degree of inversion, which is not a pleasant sign, because ultimately when the yield curve starts to invert, you're on the clock for forward coming recession. So everybody kind of focuses though on like the Fed, and they just miss the bigger picture. And the bigger picture is, the Fed is raising rates. And the rates they're raising, it's like the overnight, it's the discount rate, so forth. It's like the overnight rate. But even like 1 month, even 1 month is only up to like 0.19. But the Fed actually raised it above that. Nevertheless, okay, the detailed part of this is the longer end of the curve. And again, the longer end of the curve is starting to invert. And hey, listen, it is what it is. There's nothing more effective than just looking at, definitive data in here. There's the definitive data. Again, yield curve is starting to invert. Now, again, depending upon who you are, maybe it is the 2-year over the 10-year or the 5-year over the 10-year. But any way you want to look at it, it's flattened and inverted in some cases. So that's where I wanted to start with this weekend's update, because I call it fun with the Fed. Like, who cares what they're saying? Who cares if people think that they're hawkish or dovish? Who cares? The yield curve is inverting. Listen to the marketplace. Stop listening to all the rhetoric and all the garbage out there. Listen to the marketplace. Look at the facts, right? Yield curve is inverting over there. The next thing you have to think about with that is who wants to fight the Fed. I brought this up week in and week out because for the last 10 years of my trading career, all I hear is if ever I got short something, if ever, okay, I took a bearish position, somebody said, don't you fight the Fed? What do you mean by that? I go, well, the Fed is zero interest rate. They're bulking up their balance sheet. Well, guess what? Welcome to the marketplace, because they're doing the exact opposite right now. They're cranking up the interest rates, right? Okay, they're cranking up the rates, and they're going to be contracting the balance sheet. You want to fight the Fed? You go for it. But it's one of the places that I wanted to start on this weekend's update, simply because you look at the rip your face off rally, you're like, that's it. They've bottomed. Okay, maybe. But I'll tell you what, if you look at a longer term horizon, we're going to keep interest rates, bidding up those interest rates, then there's no question that this is not a bottom. It can't be. Right? Because you would never want to fight the Fed, and the Fed right now is going to be against the markets for a considerable period of time. Again, that's a statement that I had to hear for 10 years. Okay, if I ever took a bearish position, well, now I'm going to throw it back at you for the next 10 years as, again, the marketplace is absolutely right now fighting the Fed. It is, again, it's that quintessential rip your face off rally. All right, done with the FOMC discussion. Let's get right down to brass tacks, though, over here. There's some risks on the horizon, all right? Volatility contango is back, but it's far from normal. Let's actually go look at the volatility futures, because this stuff, it really matters. In fact, for those of you that don't speak volatility futures, you look at the VIX. The crush in the VIX, no question about it. It's big boy crush. Big boy volatility crush throughout the course of this week. Now, to read into this, all right, we were going up and now we're going down. Don't look at the technicals ever inside of a VIX. You just want to see that, hey, you can see there's a significant volatility crush. And I have to tell you, that volatility crush, oh my, did it help me. I sold so many puts, okay, out there. And I have ripped apart most of my position, almost everything I've had on, okay. In the past few months, it's worked. We haven't even been threatened on either side. We haven't been threatened with calls that we've sold, puts that we sold. But you'll see my inventory right now, and so I'm a premium seller. My inventory is negligible. And every piece of inventory I have on, whether it's spiders or S&Ps, it's on the dance floor right now to be closed profitably, or should be closed profitably. Like, everything that I have on is effectively working. And it's thank you, volatility crush. Let's bring back the pain, because hey, we want more volatility at this point in time. But as I was saying with the volatility contango is definitely back. I'm going to talk about vol contango. Again, I'm speaking a little bit of geek, but let me go ahead and bring up volatility. And what I'm going to highlight for you is right in here. All right. What matters on this particular screen is simply when you start looking at volatility. Here's the active contract, which is none other than the April contract. And if you take a look at April versus May, and you're looking at, 2603 versus 2560. So again, you put this 2560, then the next, month out jumps up here to 2603, and then to kind of map this a little further all the way into June, and June is like 2637. Like, there is a contango, but it's a very, very mild contango, very, very mild. So we have definitely cooled off when it comes to volatility, but we're far from, sounding the all clear. And again, I'm actually taking you even to further expirations out here. Just take a look a little further out with me. The volatility skew is actually flattened out. All right, so we're kind of looking a little bit like this in terms of vol skew at the present time. And you go, well, what does that mean? Okay, it means that risks in the present time yes, they've abated to some degree, but they're pricing them similarly to risks in the future, which is kind of unusual. It's like an uneasy sign inside of the marketplace for vol futures. All right, so enough said on that front, and I'm not interpreting it. I'm just looking again purely at the numbers. The next thing that is actually an area of concern specific for me is if you take a look at the dollar. So I've actually still got long positions in the dollar. The dollar definitely came down a little bit this week, but it is still rather bid. I mean, it's bid. And the dollar to me has also been like almost like a new version of the VIX. All right, so it came back a little bit. This is a trade I want to watch very carefully in this next week or two, simply because, all right, if the dollar gets crushed down to like 96, I'll be, oh yeah, some of the risks have really abated. But at this point in time, dollar remains bid. I'm going to be on my game. I'm just going to be on my game looking for the next round of extreme volatility to hit the marketplace. So the other aspect that is going to cause some risks on the horizon is oil is back. Oil actually a wicked bid hit the marketplace, obviously, on Thursday. I mean, people, you got to understand, we're talking about 7 to 10% moves every single trading session. I mean, it's kind of a moot point. Like oil didn't do that much ultimately on Friday, but on Thursday was a really strong bid back. But oil is finding a home above the $100 a barrel kind of handle. And if oil continues higher, hey, it's only a matter of time before everybody's going to go, this is completely out of control. The risk is overwhelming me, right? Well, what is out of control is inflation. So inflation, if you've, I mean, completely, totally anecdotal, is that if you've actually gone out recently into stores, you will actually see them changing prices, okay, in stores, possibly several times within a month. So that's purely anecdotal. Like I want to put any context around that. But then, of course, you have heard, like Tesla, okay, they adjusted price twice inside of a week. And that is, they adjusted the price of their vehicles. The entire lineup of vehicles were actually adjusted twice within the same week. That, people, okay, that is definitive. That's not anecdotal. They adjusted them price, twice. And I think to this, point, and I'm like, wait, they couldn't get it right the first time? Well, it wasn't enough. All right. So, or are they just trying to gouge people, prior to what is ultimately an amazing amount of demand at this point in time? So either way you want to put it, I would actually put it as inflation is completely out of control. And, people talk about 7.9% CPI, but I'll tell you what, if you looked at CPI the way it was calculated years ago, you're actually over 16% in terms of CPI, if you're unaware of that. Nevertheless, inflation is completely out of control. I think there's negative implications for retail because you're going to spend that much money on gas. You're going to spend much more money on food. I would look at retail as being one of the areas that's going to take a hit in the near future. People are going to be a little less, froggy to want to go out and spend substantial amounts of money because bottom line, they're not going to have it. It's going to be a real concern. This is not in the very near future. I'm actually looking, months out. And I wanted to make that, again, very definitive. Last thing is risks on the horizon, the quintessential rip your face off rally. So let's state the obvious here. Again, back to the obvious, the marketplace explodes to the upside. We'll look at expected move on this front in just a moment. But what I find interesting is when I look at this is a 180-day 4-hour chart in the S&Ps. And again, just to give you a feel of where we're presently trading here, okay, in the trading range, okay. Although extensive and significant, one of the things that I want to point out on this particular front, there is a fantastic amount of open interest that still exists right in between 4,400 and about 4,300. Unquestionably, we have still, we could see some upside early in the week, but there's no question. I think at some point we're going to pull back right into what we have termed that volatility box. And to get really specific, I'll come now to a 30-day 1 hour. And I say I get specific in here. I think we're actually going to channel right back into this kind of happy place of a range. As I said, open interest, okay, lies right here. We were on a huge gamma squeeze to the upside. We've seen gamma squeezes to the downside. Again, this rally probably long overdue, but I do think that the rally itself went further than anticipated, predominantly because of an expiration cycle and a huge gamma squeeze. And this is actually where I referenced the SPX. The SPX, the mother of all products. So inside of the SPX, we were looking for just about, in this case, about $145 move. was the expected move. Yeah, you got that. And then some. I mean, the upside edge of the expected move was 43.50. We closed at 44.60. 100 handle move outside of expected. That's huge. It's huge by huge. And there's no, denying the fact that we had this huge rally. Volatility got crushed, which is fantastic for those of you that have sold some premium. Didn't matter where the premium happened to be. You sold it. Vol got crushed. It worked. So push all of that aside for just a second. So again, I wanted to talk about some of the risks on the horizon because the volatility hasn't normalized. The dollar's still bid. Oil is back, right? Inflation's completely out of control. You have to realize we're going to keep going in what I call the merry-go-round of risks. We're going to go from geopolitics. We're going to jump right back over to inflation. Then with inflation, they're going to say, oh, what about oil in the commodity market, right? It's not going to stop and it's not going to let up. And that's why, hey, I'm not here to be, the bear, but again, you don't want to fight the Fed. The risks are still on the horizon. And let's say, let's jump right to it. The geopolitics, okay? Geopolitics are obviously, all right, front and center. All right. Has the war, dissipated? No, not at all. Nevertheless, okay, one of the things you want to think about, even if the war ended tomorrow, and this is the point that I am trying to make over here, sanctions are not going to disappear. They're not going to dissipate in any way, shape, or form. So the sanctions that we're going to see, in fact, could even become more strict if the end of the war does transpire, because pressures are going to be on, again, everybody in terms of, sanctions. Of course, Europe, there are many sovereignties that still have not fully enforced all of their sanctions yet upon Russia. The point that I just want to make with the geopolitics, listen, damage is already inflicted. It's already inflicted. Okay. At this point, if you look at the damage that's been inflicted by the geopolitical risk, if you look at the damage that's inflicted by sanctions, it can only at this point get worse in the near future. And that actually would include, of course, China. And we're actually going to see some of the moves they're going to make. So again, when it comes to risks, you give me a reason that geopolitical risk is going to abate, and I'll give you 20 other reasons that it's not. And it's one of the things you have to recognize at this point, okay? Those sanctions by the U.S. have already inflicted damage, and that is not going to resolve itself anytime in the near future, okay? So again, we can see out of the war, there's only negative implications at this point moving forward. And that's one of the risks that is going to be bearing down on us consistently. I mean, the geopolitical, picture, even if it does get better, okay, hoping the war ends, it's not going to change the sanctions. It's not going to change the pressure that's on European countries, okay, to literally, do away with business with Russia for the foreseeable future. All right. Moving on from there, trade setups. So let's get down to some business here and trade setups. I see actually a pretty good setup inside of gold. Like oil, gold got crushed recently. And again, I'm not a market technician by any stretch of the imagination. Nevertheless, this gets crushed with the rest of the commodity market. There's a little bit of a bid back. Maybe we back off. I actually think there's a decent rally that could be due all the way back up to the 2000 level inside of gold. Now, this is also true of some of the other commodity products if you're not necessarily into gold, right? So if you want to take a quick glance over at like silver markets and so forth, it's similar. I mean, almost every single chart you look at is going to be very, very similar. A bid back coming into the commodity markets, though, within the next couple of days is a trade that I'm looking for. In fact, I've already positioned myself a little bit inside of GLT for this to transpire. And I'll look for a couple of different positions in here. Let me knock down the number of strikes. You see in-out spreads, out of the money, call spreads and so forth. The cool thing is inside of the gold market right now, the skew is actually favorable, meaning that you're buying an option with a 19.85 vol and be selling an option with a 20.3 vol. So again, skew is actually favorable inside of many of the commodity markets for bullish positions. Now, does that mean, we're going to turn and burn to the upside? Not maybe in the, immediately, but without a doubt in the course of the next week or two, I think we're going to see a decent bid back in here. And again, that's because if you look at the volatility futures, they haven't necessarily abated, right? You look at the dollar, it's saying that risk is still very prevalent. And if you look at products like gold and oil, obviously there's still some issues out there. Even though we've come down on gold and oil, okay, they substantiated, their marketplace right here, for instance, on gold, like the 180 level. This is GLD in the 180 level. Not dissimilar, though, to the oil contract, which pretty much substantiated under 100 and then found its footing. Again, everything looks really similar in the commodity market, whether it's metals, whether it's oil. Okay, it looks similar. Don't even get me started on wheat or again, some of the metals have been having trouble still in London, like the nickel market, still having trouble opening. All right, with that, so a bullish setup in terms of gold. The next thing I wanted to present to you is there's not a favorable risk reward presently inside of S&Ps or spiders. So let's look at the S&P 500. Risk reward following the rally, okay, is going to be diminished in this capacity. So let me bring to your attention. All right, so something wonderful happens maybe over the weekend. Okay, the geopolitical front, the risks actually abate, and everybody's thinking that we're going to explode to the upside. I think in some context, this marketplace has actually already priced that in. I really do. I think the marketplace has priced it in. I think there's absolutely upside potential in the S&Ps on the initial news, okay, of maybe a ceasefire talk. And again, I'm giving you both sides of this marketplace. Nevertheless, the upside capacity, okay, is nothing compared to the downside risks. The downside risk, I just don't think we have at this point equal footing for risk reward. You know, you see a move roughly, let's just call it from 420, okay, up to 444 inside of the S&Ps. And you know what? Looking at the spiders, I got to be honest with you, it just doesn't do it justice. This is a huge move. It's just an absolutely huge move. You even look at the overnight trade. We're down here at almost 4,100, and we ripped this week 4,100 and ripped this week to 4,465. I'm including overnight trade. Forget it. Just do it all. Throw it all in there, right? You see like a 300-point rip to the upside. And then there's plenty of upside in here. There's upside, okay? But the downside risk outweighs it in many respects. So a lot of good things have transpired throughout the course of the week, in terms of, price action in the marketplace, but nothing has changed in terms of risk on the horizon. The FOMC, again, you had yield curves invert. We're going to come back to inflationary discussions. It's just not going to go away. As I call it, it's the merry-go-round of risk. It's inflation, it's oil, it's inflation, it's geopolitical risk. Oh my, it just keeps coming. So from a trade setup perspective, all right, upside potential, absolutely. Downside risk, still totally apparent, okay? And very likely to have some substantial pullbacks in the near future. This actually bodes extraordinarily well for premium selling. Listen, okay? Don't go out there and load the boat until we actually see. If you're going to sell some premium, don't load the boat until we actually see the face of volatility hit this marketplace once again. Again, is there upside potential in here? All right, I'll state this 10 times over. I may carry bearish positions right now, but I am benefiting from the rally. So I want to say that again. I may carry bearish positions, but I am benefiting from the rally because the rally actually alleviated, all right, a lot of the volatility risk that I've been taking. I was able to close those positions very profitably. When it comes to premium selling, let's bring the pain again. There's no question I want us to go back into now a bout of volatility, and I see that there's still upside potential in here. So at this point in time, I'll tell you exactly what I did with the premium selling. I'm actually going to cruise directly over to the SPX. Okay, behold, the SPX, the mother of all products. So this past week, again, about $144 move. We smoked it. $144 move and then another $100+ on top of that. I mean, it's phenomenal, right? And the SPX to see, 200, 250 point move, okay, is jaw dropping. I mean, the last time we saw that, it was to the downside. Okay, I mean, that was the last breach that we had of expected move inside the SPX at the end of a week. We have to go all the way back to January 21st. One of the coolest things about tracking expected move. Since January 21st, since that was the real onset of the volatility, I'll be frank with you. The S&Ps haven't really progressed lower. They haven't done anything. Okay, we are trading inside of a really hot volatility channel at this point in time. And that's one of the other factors that really goes into, again, when you look at this from an expected move point of view, the marketplace has actually gotten it right. Since we saw that huge burst of volatility, we have been inside the expected move. What counts is not breaches of expected move throughout the course of the week. Okay, what counts is where are we at the end of the week? Did the options market get it right? Did the options market get it wrong? Right? Here's a week it got it wrong. Here's a week that got it wrong. But for the most part, where do we end up? Yeah, the exact same spot. I mean, it's crazy to actually look at it in this perspective. So upside capacity, sure, let's get crazy. I mean, this week, to say that we can't go up anymore is ridiculous. I mean, look, you have an expected move in this coming week of $106. So the expected move has been dampened down, of course, because volatility has collapsed. Nevertheless, okay, we could see an upside move here, 45, like 70-ish. I mean, we're talking about wicked moves back. You're stones throw away from the all-time high, fighting the Fed with everything that's actually transpired, with higher prices, with inflation, with the oil. And again, those risks are mounting. But in the near term, you'll always see disassociation of price action. And this is disassociation of price action to what's actually going on, okay, in the real world. And this is a gamma squeeze. So forget about sometimes what you think, what you know. We could explode to the upside, but there's no question that eventually that merry-go-round of risks is going to come back. And when it does, you got to be prepared for it. So again, risk reward to the upside, there's absolutely upside potential. Downside risks, though, okay, are pretty spectacular, right? Nothing is going to change overnight. And when people look at, oil or inflation or geopolitical risks, have the markets bottomed, okay? I think in the very, very near term, this next week, sure, the markets have bottomed. Longer term, you're out a few weeks, a month, into the summer, absolutely unequivocally not. That we're going to see the marketplace get systematically ripped apart. Keep looking towards sectors like financials. Keep looking towards, again, bearish to the financials. You're like, why bearish in the financials? They're only down 1% on a year-to-date basis. Look to products like Walmart. I talked about, the geopolitical risk, but really, inflation at this point, I think, is going to grip hold. And inflation is going to hurt a lot of the retailers, specifically something like Walmart, which is actually, flat on the year. Last, but definitely not least, okay, mega market capitalization. Okay, we started to come apart at the seams. They got a little bit of a bid back under them. Okay, but like the Microsofts, the Apples, this is what's holding, okay, the entire marketplace, not just the NASDAQ, but the entire marketplace together. Let's also have respect for the fact that the NASDAQ hit into bear market territory. And, well, this here in Apple looks like that bear market rally. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.